All right. Come one, come all. Everybody, we're going to give it a minute or two while everybody pours in. And you know what I'm going to do? I'm going to do something fun here. I am going to share my
Record it.
screen, and then I am going to launch a poll for everybody to break the ice and get everybody to have some fun here. This is, hey, don't ruin it, KP. If you know the answer, don't ruin it. And you obviously you do, Rob. Oh, look, we've got some folks who know. The
Do,
turtle.
do people just click on the
Yeah, you're not allowed to, obviously, Rob. Come on. It's your animal. I love this. This is why people, this is the reason that people actually came to the webinar. I want to be honest.
The most famous pet in the entire housing industry.
probably
Hey,
maybe.
Hey, just so you know, I'm a huge cat aficionado. Peppercorn.
Oh, you did it, bro. Come on.
Oh, come on. Everyone knows. Jesus Christ. Come on. Like everyone, there's no way anyone's going to get this. No way. Who put dog? Turtle? Come on. Myrtle the turtle. It's actually pretty good. There's
Myrtle the
no
turtle
way.
is really good.
There's no,
right.
now I tried to click Marmot because that's a line out of Big Lebowski that nobody gives a rip about the Marmot. But I came home from Nashville, the NBA annual, and my cat of almost 20 years, literally almost 20 years, was on her last legs. And so my second daughter, she came with me and we put her down. So I ended conference season with the death of my cat, Peppercorn. So
Oh man.
long live Myrtle.
How old was Peppercorn?
I found her as a stray in Austin, in almost 2 decades. She was 19 and a half years old.
Wow. So did you enjoy going to the vet? And then the receptionist comes out at the appointment time and says, Peppercorn Peranio?
Awesome.
My cat did not like the vet. That is for sure.
Well, I'm going to give this over to you, Rob, and we can kick this off in just a second. But please accept my friend request on LinkedIn to Myrtle Chrisman. And in case everybody's still wondering, Myrtle's a cat. All right.
No.
All right, Rob, take us away.
So, Richard, thank you for having us today. I think what we really want to start with is not a dour analysis of the industry, but or where we're going and where we've been, but more try to make this as constructive as possible this session. And we're looking at the true cost of mortgage operations, and I think it's always interesting when you talk to people about how much does it cost? Like if you talk to somebody about their utility bill or how much they spend every month, or let's look at your credit card bill. I think people are always surprised about what they see there. And the interesting thing, obviously, when you're running a complex organization, there's all kinds of costs that you may or may not be aware of and that may surprise you. So I think I'd like to talk about that today. And, if it's okay with you, we could the two of you could introduce yourselves for 15 or 30 seconds each, even though everyone probably already knows you.
KP, please take it away, man.
Okay. Thank you, Rob. My favorite thing to do when I'm together with Rob is to try and make him blush and give him a compliment, but I'm not going to do it today because he will deflect. It is quite an honor to be on here with Rob, obviously, and Rich. Richard's been with a couple really good, innovative fintech companies now, and so it's always a pleasure. I'm KP, one of the 4 owners of PRMG. I've been with the company 13 and a half years as chief lending officer. My main role is to oversee, sales and the harmony between ops and sales for our correspondent, which is both non-del and delegated, and then our wholesale and our retail channels. But as a shareholder, I get to see a lot of different stuff, and it's fun to share with the world what we're thinking and our thoughts. And we just had a senior management meeting yesterday, once a month. So I've got some fresh information. Look forward to this great conversation.
Love it.
That's good. Kevin, you have senior management meetings and I've got senior moments. So anyway, Richard, on to you here.
I'm Richard Grieser. I'm VP of Marketing at Truv. I just love the banter between KP and Rob and had to get them on a webinar. So that's why I'm doing this. But also to see if we can come up with some really good strategies that we can share. Maybe the audience can take away some of those today to lower the cost of doing business and lending. We could all use it.
And it's important, you don't, when you see the average cost per loan and the average loss per loan from the MBA, it's really sobering, frankly. And you have a lot of people out there saying, wow, if you're going to lose $1,000 a loan, you don't make that up in volume, those kind of comments. So I wanted to talk to the two of you about, if you look at the statistics from the first quarter, and I can't believe we're in the last month of the second quarter already. But if you look at the companies that were profitable in the first quarter, I think the number was right around 60% of mortgage companies were profitable in the first quarter. But per loan costs are still increasing. They're up well over $12,000 a loan, up from the fourth quarter of last year. And I wanted to ask Kevin, start with Kevin. What is driving these costs to keep increasing?
There's a lot of different reasons, and I love that you're quoting some information from the Mortgage Bankers Association. They do such a great job with their research and analysis and breaking these costs down to get very granular. So let me just preface this by saying we are built by originators for originators. And in a purchase market where it's grinded out, doing battle, lock and arms realtors whose commission is under attack with the NAR settlement, it's all about sourcing and finding and grinding it out and trying to get deals done. And that puts a lot of value on the originator. And as loan amounts go up, we see home price appreciation go up every month, it seems like. Certainly, when you smooth it out with all the wrinkles in a 12-month, calendar cycle, home prices are appreciating. That means loan amounts go up and the commission is going up for originators. And that is your biggest cost to produce. It's not an attack on it. It's just a fact. It is what it is. If you took out that $12,500, let's call it $12,600, about $2,900 to $3,200 of that is OpEx, an operational expenditure. Okay, so the cost to produce a loan, all of your staff, all of our departments, all of our, different, underwriting, fulfillment, closing, funding, post-closing, risk, losses on loans, everything. It's only $2,900 to $3,200 a loan. The rest is commission for the originator. And they deserve it because they're the ones finding the loans. So, I see that going up in these quarters, kind of commensurate with the percentage of home price appreciation. And so it's obviously not at those crazy levels you could see earlier in the chart. There's a lot less profit per loan. That's another big component, although that's starting to ease a little. That's a secondary market function. If you hear people talk about spreads, what's a spread, right? So a year ago, nobody wanted to pay for an 8% mortgage because they knew it was going to pay off soon. So there's not a lot of margin in there, in the secondary market. Nobody wants to hold mortgage-backed securities for loans that will pay off. I think everyone kind of thinks as soon as the Fed cuts at some point, every single loan that's been done the last 2 years is going to refinance. But if they don't cut as much or cut as soon, or, maybe the rates stay higher for longer and people believe it, the secondary market starts to believe it, and there's a little bit more margin. So I'll just leave one last thing. The spread between the 10-year Treasury and the 30-year fixed rate of a mortgage had gotten to some crazy level, like 310 basis points. That's improved by about 25 to 30 basis points here in the last 6 months, which is
So
great.
Kevin,
And that's helpful.
for novices like me, when you talk about 310 basis points, basically 3%. So if the 10-year were at 5%, 30-year mortgages would be at 8%. Is that correct?
That's about right. And that's exactly where it was in October when the 10-year peaked and 30-year fixed rates peaked in this cycle. You nailed it.
So to continue on that vein, digging into your capital markets expertise, you could have an environment where, quote, interest rates are stable, but mortgage rates are coming down. Is that correct?
And that is correct. And that stability is what gives potential bond buyers, mortgage-backed security buyers, institutional buyers, that gives them some certainty. They feel that the market's less volatile. It's hard to decide how to spend literally billions of dollars every day. So yeah, that's dead on.
All right. Richard,
Yeah,
are you seeing the same thing?
well, we had a good question actually that I want to address from Patrick in the chat. I like things to be participatory. So if you're watching right now, you've got a question, we'll address them as they come up if it's a good question. And I think Patrick's got a good question. He just wants to confirm, did he hear this correctly? Assuming the CTO is $12,593, the out costs are $2,900 to $3,200, and the rest is paid in commission. That's the clarification question.
That's correct.
Yeah, and so that's why you're saying, yeah, go ahead.
Yeah, and I would say, Patrick, you can also get a pretty detailed breakdown if you go to mba.org and you go into the newsroom, which is one of the links at the top of the page, and you go back to all the press releases. The MBA does a good job of releasing the cost per loan and the data. Like they will break it down. They will break down that $12,593 to the dollar. So some great data in there. And yeah, commission is the biggest part for sure.
Well, so I'll take the stab at answering, get just a quick turn to my plug. This was the data that I threw up on the slide after talking to Rob, and Rob kind of guides me on what data I should go and pull. What really struck me is when I pulled Q3 2008 cost, the average cost per loan, all the way up to Q1 2022. If you took the average cost, it was $7,305. And if you look at that jump in increase in costs just to Q2 2023, it's about a 51% jump, right, from that average. But if you look at the jump from just 1 year ago, it's 14%. That to me told me there's something that's wrong here. And that's kind of why I called this webinar together. Originally, I asked Rob and KP to jump on here because something's happening in the industry that's accelerating these costs, like way more than it has been historically. And it's very clear. So we're going to get into answering exactly what's driving that.
That's a great stat that you have right there on the screen. And you are comparing a Q1 where there's less volume because January and February are typically your slowest and shortest, coldest, crappiest months of the year, to a Q2, which is usually the best quarter of any seasonal purchase year, right? March, April, and May are, April, May, and June are your sweet spot for spring purchase season. March is great. And sometimes March is good enough to bail out all of Q1 for a lender's profitability. But April, May, and June are peak purchase season. By far, the most volume is in there, and so it's slightly apples to oranges. But you know, again, most lenders, we're happy to pay our originators the commission because they're hunting the deals. So I have to focus as a lender on that $2,900 to $3,200. That's what I can really control, that I want to control. So how do I work on my cost for marketing, my cost, do I have marketing, my cost for underwriting, my personnel costs, my cost for verifications, credit reports, all these different things that, we're looking at that add to that little piece. And if I can get that number down, and just, for PRMG, we are under that 2,900 number, and it's still not good enough. Like our goal is basically, our underwriting, admin, closing, whatever fee that gets passed on to the borrower, let's call it like $13.75. Our goal is to get as close to that as possible, so we're printing money.
Love it, Rob. I'm going to hijack for a quick second.
All right.
We got a poll that we're going to run really quick just to see the audience. I just want to know: are your costs per loan lower, the same, or higher than what we just showed you was what was just shown by the MBA? That's $12,593. And if you don't know, there's an option for I have no idea, which is totally fair. But I think you can learn something from that, especially if someone's in, especially if someone's in the management at the lending organization.
You know, the things that we were talking about when you talk about areas that you can cut costs, and what I'd like to talk about next are kind of the buckets. Where are these costs coming from? But when you look, or when you hear campaign talk, or talk, when you hear politicians talking about, oh, we need to cut the budget, cut the budget, cut the budget. And when you look at where the government spends money, regardless of administration, so much of it is in, Social Security and Medicare and, the armed forces, areas where the government might not be able to cut at all. And when you look at the discretionary spending of any administration, it really is similar to the discretionary spending that's spent on a loan. I mean, Kevin's right. You do need people out there getting these loans. So the question is, how can you trim operation costs? But go ahead, Richard. Looks
No,
like
we have the poll results. I've just shared them with the group. So I think the folks that know, the majority is lower than what the MBA is sharing. And there's a good, I think basically the same number of folks in the audience have no idea. So KP, I would just ask you, does it surprise you at all?
No, I don't think so. I think, last year, lenders that were heavy in non-QM were more profitable. There's a lot of non-QM lenders that did a really good job. The Scotsman guy just released the rankings. We were, I think, top 10, maybe 8, 7th. I don't know where we were. Somewhere in the top 10 in non-QM production, and we're an A paper lender. So it certainly helps out. Consumer direct is a model type where origination commission, or LO commission has crammed down quite a bit, and it's not the best model in a purchase market. It's hard to trust someone on a headset, in a random phone bank somewhere with your local decision, especially if you're a first-time home buyer. But they still get it done, and but that model is usually pretty profitable because they don't put as much credence in an originator. They just don't put the originator first. They put their tech and their marketing first, and they try and give a better deal to a consumer by cramming down that $12,593 by gutting out the commission from it. It's just a different kind of model, right? And so, and just, if we're going to wax, philosophical here, there's a lot of forces out there that are technology people that are not in our business, that are trying to come in and say, why do we have anything in the middle? Why don't I just have the borrower be able to get the best price and the best experience, the best everything, the best right there at the click, like ordering a Lyft or an Uber or, whatever it is that's convenient to you, So there are a lot of forces that have been trying to circle around and get more data and tech driven to cut us out of the middle, who are originators.
Yeah, that's a very difficult thing to do. That's a big advertising slogan, right? Oh, eliminate the middleman. And that's nearly impossible. You mentioned Uber or Lyft. I mean, even Uber or Lyft are taking whatever slice they take and leaving the drivers with whatever. And it's surprising how much the company takes versus how much, when you pay, you pay $30 for an Uber ride, and how much the company gets versus how much the driver actually gets. So it is interesting. I also wanted to go back to that. Richard, you don't have to change the slides, but I think it's very important for management to tell employees, and I don't know who all is on the phone today with us, but it's important for everybody at the company to have the same goals and objectives as senior management, because you want to incent the employees to all go in the same direction. And part of that, I think, is education. And part of that education is saying, okay, the MBA said it costs this for, IMBs to originate a loan, and here's where we are. and here's what we need to do to get to wherever we want to go. And so it is important. I think it was a little bit disheartening to say, I don't know, because arguably I think folks should know. So go ahead, Richard. Oh, well, I should
No.
ask, I mentioned buckets a few minutes ago. What are the major cost buckets? And what kind of change are we seeing? Kevin, can you address this?
Yeah, I mean, for what we focus on at PRMG is the OpEx. We focus on the operational expenditure. And by the way, as a 3-channel lender, we have different models there which address compensation differently. So just not to take that too far, and beat a dead horse here, but if you're a broker, your maximum compensation is 275 basis points to run your entire business. You are capped by Dodd-Frank and the LO comp rule. So that forces you down. Right? And that's to run your business. That includes all expenses, right? Correspondent can be a little higher. If you work at a bank or a credit union, we all know that model. Those LOs don't get paid a lot of commission. Maybe they get paid 75 bips, 80 bips. Some are even less than that. And so the bank and the credit union's like, hey, these are our members. You're lucky to be working here. Maybe builders have, I don't know the comps at builders and their mortgage arms. Like, we're the builder. We built the product. So they're coming to us no matter what. We have a housing shortage. I don't need to pay you commission. So there's just all these different models out there. And the good thing is there's enough business to go around, which is why we have 3 channels. So we focus on, being, operationally excellent in the costs that are, driven there behind the scenes. So how do I get more data driven? How do I, how do I compress that loan process down with as little human error as possible? And then our people that work in fulfillment, let them focus on the exception processing, the deals with hair on it, the deals that like someone needs to look at with some eyeballs. They can't just get data here, here, and here and just pump it through the system. We work on those deals too, but we don't do that to eliminate jobs and people. We do that to allow our people to work on the tougher deals. 9QM is a great example, which of course they're higher margin because they just take much more time and effort. So yeah, I mean, all these different buckets that are on here that are on the screen, we're working a lot on OpEx, on that 2,900 to 3,200. Credit reports, wow, what a pain that is. There's a lawsuit now, I believe, against the Work Number. I saw it's out there, that just came out like last several business days. I think it went out Thursday, Friday. It's an interesting development. There's so many different facets of that $2,900 to $3,200 that we try to attack every single day, and having a technology partner to help you tackle those costs and create efficiency. If you can create efficiency and cut costs, that's a huge double win. That's a win-win.
So, yeah, you've raised all kinds of issues. I wanted, and Richard, you just put up the question that I actually wanted to ask, which was ask you specifically. You see a wide variety of clients in your job. You work with a lot of clients who are saving various amounts of money or trying to save various amounts of money. Can you talk about some of the strategies that you are seeing clients execute to that end result?
Oh,
Yeah, I mean,
go ahead, KP.
Oh, go ahead, Richard. No, you first. I've talked enough. I'm going to drink some water.
Yeah, I mean, Rob, did you intend to ask that to me? I just want to make sure.
I did.
Okay.
I know that Kevin has some ideas, but I wanted to ask you because one of the benefits of working with you are cost savings. So, but maybe you could touch on some of the other things that you're seeing, because you must see companies doing certain things and you think, oh, that's pretty neat, or, oh, I can see how they can save money doing that.
So the number one reason that folks come to Truv is because they save about 80% over the the incumbent verification provider. That's the number one reason why most folks want to work with us, right? We're a consumer permission platform, meaning the borrower gives explicit permission to pull their data from their payroll provider. It's direct from source. It's up to the minute. It's as accurate as it gets, and it comes with full reps and warrants from the agency. So right there, that in a nutshell is our value proposition. That's why clients are loving us. What I see is amongst different lenders, I see different levels of success, and I see different levels of success in the way that they implement. And if I had to attribute a reason to more successful versus less successful, it really comes down to leadership. So we have a couple of clients that, and KP knows this, we have a couple of clients that only use Truv. Like they have eliminated the incumbent and other forms of doing verifications. And their conversion rate is through the roof. And because it takes that kind of strong leadership to push that in the organization. What's amazing is to see that that is possible. And I would say that in general, it's usually better when an organization has a does not use a choose your own adventure policy, where the leadership says what's a leader's job at the end of the day, right? Is to solve problems. That's kind of my observation over time. Leaders are here, right, to solve problems. I got a CRM, nobody's using it. I got to get another CRM and solve a problem. Cost of credit's gone way up. I got to do something about this. I got to solve the problem. My verification costs are high. I got to solve the problem. And the leaders that get laser focused on solving the problems are the ones that typically they really wave the flag and charge it in the organization, and the organization gets behind it because it is change. The incumbent is doing this behind the scenes. The borrower doesn't have to do anything, right? So for example, with Truv, the borrower's got to log in, and it's a change for the way that organizations are used to doing it. But I guess my 2 cents right there is just that strong leaders are really shining right now in this market. And in terms of the ROI, that I see it clear as day, just for our product. KP, you want to add anything to that?
Yeah, I mean, we're huge fans of Truv. We verifying employment is a big deal, right? And so from a risk management standpoint, do that in a quick, efficient, cost-effective manner is so important. So I will tell you, you guys have a great tech team. You guys are true technologists, and you came in and built fantastic tech, and so we love it. It's the best tech when it comes to employment verification that we've seen, and so we're constantly trying to get data straight from a source, right? So if a borrower is willing to come in, which they are, I mean, first-time homebuyers are skewing younger. They freely give away all their data, their usernames and passwords. Yeah, log in here. I don't want to be talked to. Don't call me. So we're getting data straight from the source from all these different places, which is fantastic. And so I would just say that that's one strategy we've implemented. We're trying to think of ways on the credit report side to do that as well. We're trying to think of ways to get credit data and pre-qual people without having to pay the exorbitant credit fees. Although we have some great credit partners. I mean, I know you guys have done some work together, Truv, together with Zactus, and they're a great partner of ours. And so, that's a big cost that we have to deal with. My underwriting, that is from a human capital expense. My underwriters, we cherish them. They are the inside that drives the outside. They allow the salespeople to do what they need to do and confidently go out and sell and get business in the door and know you're going to get an answer to get the deal done, or that you have an underwriter that does what they can to find a solution to get the deal done and still have a sellable investment quality grade loan. And they're worth every penny, and they're expensive. When I don't know how much volume is coming and we didn't hire ahead of this flush of loans, and then we're paying time and a half, it's very expensive, right? Which we're happy to do because, if we're doing it because of too much business, that's a great problem to have, especially if margin continues to come back in from the secondary market, which we still have margin compression out there. So, how do we hire the best people? How do we have the best people that work in ops at PRMG? How do we maintain the best leadership of that operation team? How do we keep them happy? How do we make them like their job and let them know that they're part of a great privately owned organization that supports 2,000 plus families every single month getting into a home. How do we put them on a pedestal and thank them? So there are a lot of different ways to address operations and all the different mechanics and people and parts that go with it.
So
Katie?
Kevin, one of the questions Alan asks here in the chat is there anything lenders can do to provide more clarity to their rules / remove underwriter discretion to decrease the stress on MLOs so an MLO can be might be happier with less compensation? Any thoughts on tweaking the model a little bit to along those lines?
Yeah, I will tell you that underwriters wholeheartedly have the best intentions. So let's just start there. And then so do the lenders they work for. So, I see it. I've been in the weeds. I started this business in 2001 as an account executive in the wholesale side, and people came to me to solve problems like, hey man, your underwriter added this condition and I don't need it, And so, there's a beauty and an art to that. And thank God it isn't all data driven, because if it was way more black and white and there wasn't gray area and hair on deals and all that back and forth that can be frustrating, what do we need it for? I mean, literally, you want to erode yourself out of the business as an originator? It's get more commoditized loans. We don't want to do that. So, so the fact that there still is, some sausage making that goes on behind the scenes is what brings value to both the originator and the underwriter. How do you navigate that water? Again, if there's no like black and white, like, well, what about this credit explanation, or why is this person's income wonky? Okay, they're a nurse. They have some shift to income on this pay stub, but not on this pay stub. Is it actually good for a month, for a year, for 2 years? Can I count it? Like all that back and forth and that kind of talking an underwriter into the comfort of the deal, honestly brings value to the originator. And so, again, you got these technology people that come in from outside of our business that want to get rid of salespeople and their commission, and underwriters too, by the way. And they want completely fungible, commodity loans, and they want to just cram them through in a heartbeat. And, well then, none of us are really needed, right? So, let the AI just do it. So, there's no silver bullet answer to that, but I will tell you that, at least what we do at PRMG, every time, if we see an underwriter that's maybe new to our culture and they add what we call a comfort condition, we're saying, hey, you know what? You don't need that here. We sell directly to Fannie, Freddie, and Ginnie, and this is not part of their guideline. And this is not an overlay here. Maybe it was where you came from. No problem. Your intentions are good. Next loan, don't worry about it. So that's how we kind of tackle it one at a time.
Interesting. All right. Good answer. Thank you.
Thank you.
There is one more question in the chat, KP, that I think is actually a really good one from an operations standpoint. I put your technical LOS operations hat on. Amy, great question. You said, what are you seeing as the average cost per loan for your LOS? And, I think this is kind of a nuance on how you calculate ROI essentially, but, for your LOS specifically. So what she clarified when I asked is looking at your annual LOS cost plus your salary for administrating the system over the loans closed. So I think to start with, is that how you calculate it, KP? And do you have those numbers that you track?
No, we're kind of big dumb salespeople. We just how much does it cost per loan, right? Like we keep it simple. And obviously I can't get into our cost per loan, but I will tell you that ICE Mortgage Technology and Compass, that's our LOS partner, they're a great partner. They're fair. I mean, they're a massive data company that owns them. They're in it for the long haul here. Obviously they acquired Black Knight, and they are making a long data play here. So I would say that, you do these 3-year contracts, with the large LOS companies, and you try and negotiate tiers. Like if we give you this much business per month, it's funded, therefore we have revenue to offset the cost. You charge us X per loan, right? And so When things are great, like in 20 and 21, it's great for us. Like we feel like we're winning in that contract. Then when volume goes down, we feel like, oh, we got this minimum I got to pay every month, even if I don't do one loan. And so, you take the good with the bad, and that's just kind of how our business is. But I will say that, our partner is fair, and that's typically how it works. But our model's different. We're a 3-channel lender. You may have other models where, they don't have to have all that back office support or an enterprise level system. They may just need to do point of sale and, a mini LOS, so just for origination. So it's different for every company. Yes, support is a big deal. How much do you want to scale? That's the other question. Like, how much do you want to scale as a company? I mean, we want to get bigger than we are, not for the sake of getting bigger, but we feel like let's just take the wholesale channel, for example. At the end of 22, we were like the 10th largest wholesale lender. 5 of our competitors went out of business. Literally just, oof. Yeah, we're a hedge fund. We don't want to lose money. We're out. See you later. Peace. It was nice. And so, but we're privately owned. We're committed to the space, and we want to do nice, low control growth. And so, we have to think about building the resources and engineering and developers and architects and cybersecurity and infrastructure. We have all that, and it's a lot. And sometimes, you sit there and go, oh my God, we're paying $10 million a year in IT if we don't do one loan, which by the way is down from say 14 million a year ago, right? Those are our 22 and 23 numbers. Just giving you some raw numbers, and there's a lot in there. There's a lot that goes in there, and it's what model do you want to run? How big do you want to get? If you have a big lawsuit because you don't take care of your data, or if you cheat and you lie on your FHA underwriting, you have a false claims act that puts you out of business, which by the way, we self-report. We don't go, oh, we're a servicer, let's just throw this crap in there and no one will ever see. We would never act like that. And HUD has recognized that. So has the Department of Justice. We beat our False Claims Act. And so we feel like we do things the right way. And so, we're not trying to cut corners here, control growth, do it the right way. We'll continue to build and scale into the next part of the cycle. And again, those are all questions that you need to answer for your own business to actually answer how much does your LOS cost.
So, Kevin, earlier you mentioned a couple companies' names that I won't repeat, that some people in the industry will say, oh, they've got a monopoly. And monopoly has always been this kind of evil term. I mean, growing up, you play Monopoly and you're fighting against not fighting, but you're playing against people who are trying to create a monopoly, and monopoly, it's evil, and so on and so forth. Now, we've had some news recently about monopolies in the mortgage industry, and especially when it comes to verifications and credit and so forth. And price increases, and Rohit Chopra, called them out at the recent conference in Manhattan. And so I wanted to ask Richard, do you think this will continue? With a microscope on the monopolistic practices of some in the industry, especially when it comes to verification, or do you think regulators are doing something about it? And if so, are they doing the right thing about it?
Yeah, it's a great question. I've been watching the news pretty closely. KP called it out earlier that one of the incumbent verification provider came under fire with a lawsuit about exactly this. And if you look at credit and verifications, I think almost everybody in the audience, please write it in the chat. If your credit and verification costs are going up, exponentially, way higher than inflation, but let us know. That's why I would say that's why my company is so successful. It's definitely why people are looking for alternatives out there right now. And it's what Rohit Chopra was talking about at Secondary. Some of them 400% in 1 year time period. That's crazy. So, I mean, whether something is actually going to get done about it, something is going to get done about it, I don't know. There's a lot of complicating factors, right? This is an election year, right? And I don't know if things get done in an election year, to be frank.
Well, certainly at a congressional or administration level, the we're basically frozen with any decision making from here until, maybe till the end of the year. And some people like that. So what happens is agencies and regulators step in who have a little more dictatorial power than, say, Congress, and they can just do things or put things in place that will make a good impact or a bad impact depending on how you look at it. Kevin, what are you hearing in terms of regulators coming in and doing, say, the right thing or the wrong thing, or trying to take a hard look at these costs that have gone up so much?
Well, I hope you guys, I know you guys are so good. You guys aren't saying names, and I get it. And maybe I shouldn't say names either, but let's just call it what it is. And it is what it is. It's in the news, it's worth talking about. But, capitalism has a funny way of working out, right? Like, of course, every business wants to grow and be the best. And sometimes when you have such a good business model and you're the best, you get, monopolistic, or you get that tag. Capitalism has a funny way of busting that up, whether it's through regulation or the courts. And so, I guess smoke them while you got them, right? Until you got to pay all that money back that you made if it's too much. And the court or the regulator will tell you, whether you made too much or not. Having said that, it's expensive. Lenders don't. Lenders lost money generally the last, I'd say 2 years. As of this month, June was really when rates fell out. Like holy smokes. The best interest rates we ever saw was February of 22, and they rapidly deteriorated all the way into June of 2022. And since then, the last 2 years, save this last spring purchase season, the last few months we've had, it's been very tough to be a lender. And, some people take this, and I don't understand it, they take this approach, well, you made all this money in 2020 and 2021. Okay. Does that mean we have to lose money today? So when I say things like, well, we are now charging borrowers upfront for credit cards, on their credit card for credit reports, we're trying to at least, which is how it used to be done in our business, because we can't absorb this massive bill. It's a massive bill. I say that in a closed room with regulators present, and they're like blown away. And I'm like, well, what do you expect? I mean, we are losing money, right? This is a very difficult market. We've got to do something. We've got to change the way we operate. And so then we kind of pivoted off that. Some borrowers, if they push back, then the branch will pay or the LO will pay or whatever. We'll do a bundled cost. If we fund 1 out of 5 deals, then the cost for the credit report for that one deal that funds is larger than it really should be, because we have no way to absorb all those other costs. There's so many different ways to tackle it. But at the end of the day, we have to provide investment quality loans that are sellable and fungible in a mortgage-backed security in the secondary market. And these costs hurt. I mean, it's tough. And so, not every company can handle it. I mean, I see individual LOs, in these little one-man shops in the broker channel. They're like, I'm getting killed on this credit report bill every month. Well, yeah, you're running a business. You're running your own little lender, and, you're capped at 275 max to run your whole business. And this cost went up for you too. And it really hurts them. And to be honest, those street level originators in all of our channels, they're the ones serving the underserved. They're the ones hunting for tough deals. You want us to hunt for tough deals? We're going to have to run a lot of credit reports for people with bad credit. That's the reality. As for your comments, Rob, about Rohit and the CFPB, look, I love that they're shining a spotlight on things and spurring discussion. I don't know what will come of it. We're in an election year. I don't know how much is talk versus action. But what I do like is that the CFPB is very collaborative with our industry. And for those that were at the NBA in New York, we've had several years now of Bob Booksmith and Rohit Chopra from the CFPB having a great dialogue and conversation. The NBA lobbies on behalf of all of us in this industry, whether we're a member that's paying or not. And they've got a great relationship with the CFPB. And so I love that collaboration. I don't know, it doesn't feel like the days when it first got started, and it was like let's punish everybody and not tell them what we're punishing it. We want to do the right thing in the lending community. We want to serve the underserved. Let's work together and do that. So I like where the regulatory environment is right now.
I'll
Good.
just throw out there in the chat, it says Teresa was saying that several of her clients are doing exactly that, KP charging upfront for the credit pulls and with a credit card. And Mark was saying they do it at closing for verifications. So I mean, right there, that's lenders having to pivot, and change the way they're doing business to, like you say, like the business stays the same, but the costs are going up. So you got to do something, right?
Yeah.
Yeah.
Mark, I see your comment. I feel you.
When you talk about LO comp and reducing LO comp, of course, nobody wants to be the first penguin in the water, right? When it comes to, oh, we're paying these folks how much? 1.5 points. Well, maybe we should maybe we should pay 1.25 points, and we'll say we're going to use that extra quarter for marketing or underwriting, training or whatever it might be. But nobody wants to take that first step in reducing LO comp. I've heard, Richard, to that question about our lenders charging up front. Yeah, you can charge at closing. I mean, that's one way to do it. But, that person, in effect, when they pay for a credit report, they have to cover all the other loans, credit reports that didn't make it to closing so that those borrowers could pay. So you're running credit reports on loans that never fund. And that was always a question in secondary marketing, like, oh, we've got this hedge cost and we lost money on this securities hedge. What loans can we assign that to? Well, some of those loans didn't fund. So you can't really do that. I know we're running a little bit short on time, so I'll stop yammering, but I wanted to ask Kevin, the productivity, per employee, it's mostly looked at in terms of production. Oh, we want 2 loans per loan officer per month, or 4 loans. It used to be, 4 or 6 loans, and now it's almost like 1 loan a quarter. We're going to keep that originator on board. How much of a function is that of rates? Or do we need rates to come back down in order to boost productivity? Or what are you doing to boost productivity if rates were going to stay here for the next 6 months?
Yeah, great questions. And I'll share with you some data in real time, literally just from our company. I think that's one thing, Rob, why people love reading your blog, is because you guys are so transparent. You talk about this stuff. And I wish more people would come on here with you and do this. We are 10 FPE. That's 10 fundings per employee. That includes all of our staff. That's about how we've been running. We're trying to shoot for 12.5 to 15. We bracket this loan per employee on the sales side. We bracket that out by how long a loan officer has been with us. So if a loan officer has been with us for 90 days, we have a list of how many of them have funded one loan in the 90 days. And so out of 700 loan officers, you have like maybe 300 that are funding at least one loan every 90 days. Then we have everyone else, where it's basically, I would put that number at about 2.2. So, and then of course you've got your high producers, and we have people last month that funded, 25 loans, your top producers. So that whole 80-20 rule. So, this is real-time data for us. This is how we look at productivity. And as far as a salesperson getting better, there's 3 things I've been preaching for about a year and a half. Non-QM is a great way to get more profitable and get more loans. And that loan is typically going to be a refinance again later, when rates come down or that borrower gets right with whatever it is that forced them to go non-QM to begin with. So learning that product, as an originator, just learning basic product knowledge on a new product. So, the riches are in the niches. There's so many nuggets inside our non-QM guidelines. So that's number one. Social selling, love Social Coach, love the apps that get your face out there. And, don't just put your phone in front of your face like I do for free and expect to have business drive in. Just you get what you pay for, right? Just spend a little extra money, get some like professionally done videos that make you stand out, grow that database, and then mine your database. Those are probably the key to success that we try and get for our originators to get more production.
Yeah, you can't, and obviously you can't change what you aren't measuring. And you always hear from loan officers saying, "Oh, well, I've got this in the pipeline or that in the pipeline." Well, you haven't closed a loan in a month and a half. Yeah, but this is why, and this happened to that loan, and this happened to this loan. Yeah, metrics are so important. And you're right. If somebody just kind of shrugs, says, "Oh, we'll do, we're going to do whatever," or just kind of plod along, you can't do that in this environment. And I've seen it time and time again where companies have improved their measurements of different parts of their business so they can meet with managers and say, "Look, here's what you need to do," especially when you're comparing it with some of the MBA statistics or the MBA Stratmore peer group results that are out there. Look, we have this many loans per underwriter, and we are at this level, and maybe we're above, or maybe we're below. But you need to be able to change. You can't just say, "Wow, it seems kind of slow out there. Maybe we should take a look at," you can't do that. You have to have these numbers. So going back to, I'm going to start with Richard, because Richard, you haven't said much recently. Yeah. And once again, you deal with a wide variety of lenders out there. Any advice, from what you've seen in the last 3 to 6 months in terms of what's working and what companies are striving to do?
Yeah, I would say, I think everyone can be a leader and just be a leader, right? Focus on a problem that you want to solve and be like a pit bull going after it. And I think you will be able to move. I believe that there's a room for improvement in almost every part of the organization. I don't care what company it is. So just focus on solving whatever you think is the biggest problem and going after it. I mean, there are people out there that I've met recently at the Housing Wire conference that just on the revenue generating side that are very successful right now. The riches are in the niches. You've all heard that before. And for example, I just met this one direct to consumer lender who is killing it right now. They're growing really fast, and they're growing really fast because they have a talk track, one talk track. They buy leads from like Lending Tree, and they buy leads only that have high credit card debt. High credit card debt plus high equity, that's their buyer, that's their borrower. And that they have just specialized their entire operation on that. And all of their loan officers can only talk really that one track, and they're killing it. So in my opinion, there are certain niches out there. I know I met another lender who just does construction loans, and new construction loans are doing really well if you get the right partnerships. And then the third one that is just jumping to my mind right now is the lender that has a specific religion, and they only sell loans to members of that religion, and they can't be charged interest rates by policy for their religion. So that's what I mean when I say like riches in the niches. You have to really I think you can solve some of these growing revenue, which is I think harder than lowering costs right now. So that's my takeaway right now. Focus on a problem, be a leader, and do everything you can to try and solve.
As opposed to the saying that the subprime industry used to use, which is riches in the ditches. So anyway, Kevin, closing advice, closing thoughts. If your son or daughter were starting a mortgage company, what would you tell them?
Be better, be more punctual than your dad. And I did show up 2
You
minutes
made the show
before
today.
this.
You're doing okay.
The magic behind the scenes. Have better attendance. Be more like Rob Chrisman. I already blew my perfect attendance for the California MBA. I couldn't make the last legislative day. One year in, and I already missed a meeting, man. You had perfect attendance for 6 years.
9.
I set that as a goal. Be like Rob Chrisman. Attend every California MBA event, and I blew it my first year in. Gosh dang it.
Yeah, it was a term out after 9 years. Well, there was good. There was good food, and actually more seriousness. I mean, to be able to communicate with people in the same room, as equals versus some of the interaction that we have. I mean, to be able to interact with other people in the industry who are very intelligent and very well thought of is very important, and a great benefit if you can do it. So
Well,
All
for
right.
my part, I just want to say thank you to both of you. You guys constantly give back, and nobody is paying you guys. You're doing this for free. So you guys are constantly giving back to the industry. I just want to say thank you. I've learned a lot from both of you.
You bet. Richard, happy to help.
So,
Yeah, same here. Thank you guys.
thanks so
All
much,
right.
everybody.
Thank you.
Have
All
a
right.
good one.
Bye.